What separates a good stock from a good investment? It's all about timing. That's because you can be completely right about a company's growth outlook and still lose money if you buy at the wrong time. That's why today I'm giving you 5 stocks where the timing is as compelling as the fundamentals. Now, diverse sectors, clean balance sheets, and scheduled triggers in the next 90 days that could send each one significantly higher. By the way, I'm Steve Reitmeister. I spent more than a decade as editor-in-chief of Zacks.com, and I'm currently a partner at WallStreetZen, where our quant team analyzes thousands of data points across 4,600 stocks every single day. If you want to find more stocks like these before they make their big move, then hit that like button. It tells me to keep making more videos like this one in the future. All right, let's start with one that's kind of difficult to pronounce, but quite easy to like, and that's Okeanis Eco Tankers with the symbol of ECO. 329% earnings growth in a single quarter. Now, that's not a typo. There is a corner of the market right now where companies have almost obscene pricing power, and almost nobody on YouTube is talking about it. I'm referring to global crude oil tankers. That's because energy demand keeps climbing, but the supply of modern tankers remains light. That's why ECO is on the list today. The Q4 earnings it just reported in February were a complete knockout. That's already earnings beat, but also soaring profit margins running over 31%. Return on equity is also impressive at 26% in an industry where the average is only 11.4%. ECO shares have rallied about 15% since that beat. But here's why I think the next 90 days could have even more upside. The early Q1 2026 bookings data shows VLCC spot rates above $104,000 per day, greatly above the typical rates. That means Q1 cash flow is already locking in at elevated levels, and yet that earnings report isn't until the summer. So you've got months of outsized revenue generation ahead with no data point for bears to grab onto. All the while, the stock is trading at a modest valuation of just 14 times earnings. As word spreads of their soaring revenue and increased profitability, the share price and PE are going to rise, perhaps significantly. The supply side of the equation is what makes this a structural bet. These are scrubber-fitted, eco-compliant vessels that burn less fuel and meet modern environmental regulations. As older ships get phased out, their fleet advantage deepens. The company also just raised $130 million to acquire 2 new Suezmax tankers, expanding into a market that can't add capacity fast enough. Our Zen Ratings quant model is picking up on this fundamental improvement. Not only is the shipping industry A-rated overall, but ECO is the #1 ranked stock in the industry. It's never a bad idea to own the best stock in one of the best industries. Now, shipping is cyclical, and if the spot rates decline or global trade slows with tariff uncertainty, revenues could compress. Limited analyst coverage also means limited visibility into their business. But at just 14 times earnings with a fresh beat in hand, rates still soaring, and months of runway before the next earnings report, then you appreciate that the odds are firmly in your favor here. Our second stock out of 5 today is Diebold Nixdorf with the symbol of DBD. This is truly a phoenix rising from the ashes. Now, a couple years ago, this company filed for bankruptcy. Today, it's sitting on an all-time high. That kind of turnaround is worth noting, especially since there appears to be a lot of momentum to the upside. So let's dig in a bit deeper. Diebold makes the ATMs and point-of-sale systems that power banks and retailers worldwide. After the emerging from bankruptcy, they didn't just survive. They rebuilt the entire operation from the ground up using lean manufacturing methodology. Inventory is down 30%, order processing time dropped 17%. These weren't cosmetic changes or accounting tricks. This was a fundamental re-engineering of how the business runs. On the growth front, they've landed 9 new major retail clients in North America, and they're rolling out next-generation smart ATMs and self-service kiosks. Now, branch footprints are shrinking for the banks, but the demand for smart connected self-service technology is greatly on the rise. This company is positioned perfectly, which is why they're winning so much new business. Management has guided the street higher for the coming year for both EBITDA and earnings per share. On top of that, they just authorized a hearty $200 million share buyback. That's real money flowing back to shareholders and helps put a floor under the stock. This stock has surged from bankruptcy to all-time highs, and yet the peg is still ultra low at just 0.44, meaning the market is still not fairly pricing in the growth that is already in hand, let alone the still attractive growth that lies ahead. Some Wall Street analysts are starting to notice. Recently, the folks at D.A. Davidson and Wedbush both independently raised their price targets. No doubt, as other analysts catch on and as more buy ratings get printed, then this hidden gem will truly shine. Quick pause. If you want more data-driven stock picks backed by real numbers instead of just hype, then be sure to subscribe and hit the notification bell. That's because I do deep dives like this every single week, and you don't want to miss out. Next up, we have V2X with a symbol of VVX. This is a company you probably never heard of, even though they have over $4 billion in defense contract. Most people looking at defense stocks are focused on the big names, Lockheed, Raytheon, Northrop Grumman, but there's a compelling story happening a level down with V2X. Let me set the stage. V2X recently recorded an 18% earnings beat, followed by increased guidance for the year ahead. Okay, solid. Here's what makes the next 90 days interesting as we head into the next earnings report. Morgan Stanley still has it underweight on this name. Yes, I know that sounds like a negative, but hear me out. When a company beats this hard and raises guidance and half of Wall Street is still skeptical, that's what typically happens in an upgrade cycle. Another earnings beat like this one, and the bears will have to revise. Each upgrade becomes a catalyst for shares to go higher, and that doesn't take place until May. Still plenty of time to buy now before the shares accelerate. All the while, the backlog of business grows larger. Anchoring revenue through 2034 is their $4.3 billion award to provide support for the Air Force T-6 trainer aircraft. In 2025 alone, they won 2 contracts worth over $1 billion each, plus 10 additional awards exceeding $100 million. All right, when you add it all up, the backlog at the end of 2025 was $11.1 billion, and their qualified pipeline exceeds $60 billion. But also consider the V2X landed a seat on the $25 billion Department of Defense Engineering and Technology Initiative. No doubt those forms of relationship will help unlock more business down the road. The company has also struck AI partnerships with Amazon Web Services for smart warehousing and Google Public Sector for deploying secure AI across military operations. V2X isn't a legacy defense company sitting still. Instead, they're positioning themselves where the next generation of defense spending is headed, which is technology-driven logistics and autonomous system support. Not surprisingly, V2X is among the top scoring stocks in the Zen Ratings system. Most impressive is their top score for financials in the top 1%. They also score in the top 10% for safety, growth, and value. I think that's a compelling 90-day setup. Fresh earnings beat, raised guidance, a backlog that's getting bigger by the day, a Wall Street consensus that's still playing catch up to the good news already in hand, and the Zen Ratings pointing out its fundamental prowess that should lead to ample outperformance in the months ahead. As we start to come down the home stretch, we have stock number 4 or 5, which is Tactile Systems Technology with a symbol of TCMD. This company makes medical devices that treat chronic swelling conditions like lymphedema. That's not glamorous, but gross margins at 78% and next to zero debt most certainly gets my attention. 78% gross margins rival some of the best software companies in the world, and Tactile just repaid its entire $26.3 million term loan, moving its debt-to-equity ratio down to a very low 0.25. This is about as close to a fortress balance sheet as you'll find in medtech. And in a market environment where interest rates are squeezing leveraged companies, being effectively debt-free is a serious competitive advantage. This came through loud and clear in the Q4 earnings beat that included 21% revenue growth that was well above expectations. They also just acquired LymphaTech, a digital 3D scanning platform that detects and measures chronic swelling earlier and more accurately. That matters because lymphedema is massively underdiagnosed. More patients identified means more patients treated. It expands the addressable market and creates a technology moat competitors can't even replicate. Okay, here's why I think the near-term setup matters. There's a big disconnect between the recent price action and what Wall Street is seeing. The analyst at BTIG sees more than 25% upside this year to fair value, while the analyst at Piper Sandler is pounding the table, all the while the stock actually pulled back more than 10% since its last earnings call. There's a simple explanation. Management's 2026 guidance calls for just 8 to 11% revenue growth, which looks deliberately conservative after they just delivered 21% growth. They baked in a potential Medicare prior authorization headwind that may not hit as hard as feared. That's because Tactile already handles this kind of paperwork for their commercial insurance customers every single day. If Q1 comes in anything close to last quarter, that guidance looks sandbag, and the stock has a lot further to run. Our Zen rating system is certainly not missing what's special about this stock. Their fortress balance sheet comes shining through as they are in the top 1% of our financials rating. They also score in the top 20% for growth and value. The risk here is mostly about execution. The LymphaTech integration is brand new, and margins in medtech can compress during commercial rollouts. But with $83 million in cash, no debt, and analysts just now waking up to this growth story, then the setup exists for shares to bolt much, much higher after their next earnings report in May. Lastly, we have Nature's Sunshine Products with a symbol of NATR. And here's something that's very impressive. Out of the 4,600 stocks evaluated by our Zen rating system every single day, Nature's Sunshine Products is the #1 rated overall. So not just A-rated, not just in the top 5% of all stocks, but the #1 stock overall. In full disclosure, I like the stock so much that I added it to my Zen Investor portfolio in February 2026. To see all 20 stocks in the Zen Investor portfolio, then scan the QR code. Nature's Sunshine sells nutritional supplements and personal care products in over 40 countries. I know that sounds like a sleepy business, but it's most certainly not. That's because there's a digital transformation happening here that the market hasn't fully caught on with. For decades, the company relied on a traditional direct selling model with independent distributors, building relationships one customer at a time. That model was showing its age, so the board brought in a new leadership with deep consumer packaged goods experience and pivoted hard into digital commerce. North America digital sales surged 52% year over year in the most recent quarter, fueled by social commerce on TikTok and Amazon. Japan surged by over 30%, and China accelerated by more than 35%. The business model is being rebuilt in real time, and the numbers show it's working very, very well. The earnings momentum is what really sets this story apart. 3 consecutive earnings beats, 51% beat, 119% beat, and 125%. That's the market systematically underestimating what this company can do quarter after quarter. And think about that pattern means. Wall Street sets a target, and this company blows past it by a wider margin every single time. What we have in our hands is a fundamental mispricing of shares that has still not been fully corrected yet. And if the earnings pattern holds up, then each subsequent beat greatly increases fair value, helping FOMO kick in, which will allow the price momentum to truly take off. Now, it's already up 100% from last year's lows, which tells you the smart money is already catching on. But the company is still only trading around 500 million market cap with just 2 to 3 analysts covering. That's the kind of low visibility where another earnings beat can move the stock fast as most others play catch up. Now, I'm not going to sugarcoat it here. This is a small cap, and with a recent CEO transition and only a handful of analysts watching, you're going to see a little extra volatility on the shares. Or if the digital pivot loses steam or international growth cools from those high 30 rates, a pullback could be sharp. But here is what trumps all these risks, and that is the 115 factor review of the Zen Ratings quant model, ranking this as the #1 stock out of 4,600. This points to likely serious outperformance ahead. Now, tack that on top of that $4 in cash per share on the balance sheet, and it's beaten estimates by wider and larger margins over the last 3 quarters, and you add that all together, and you understand why this is my favorite pick on the list today. So let me know which of these 5 stocks is your favorite. Just jot it down in the comments section, or let me know if you're watching another stock with recent catalysts that I didn't mention here. Please be sure to share it with the community now. And if you want more timely stocks, be sure to check out my video on 4 beaten down stocks with excellent buy the dip potential.